Hello everyone. Good evening to all from ICICI Securities. So this session is just the first session in a series of webinar that ICICIdirect is conducting for all the users. So in this program, we'll be discussing the world of quantitative trading, introduction to algorithms, what all is needed to get into this field, what all the resources that are required, and so on and so forth. So today we have with us Mr. Sunil Guglani, who is one of the uh, traders, renowned traders in India. So I'll quickly introduce Sunil, who holds a good 18 years of IT experience in the field of data science and ERP. Sunil then headed the algorithm business for NCDX for quite some years and then moved on to the senior vice president position as a quantitative researcher in Share India. Sunil currently has started his own venture into the field of algorithms. And yeah, more to it would be nice to hear it from the mouth of horse himself. So yeah, over to you, Sunil.
Hello
Welcome.
everyone. Thanks for joining us for today for in the session of quantitative trading and showing the interest over here. So I will go through with some of the slides. You must be able to see my slides here.
Yeah, Sunil, we can see the screen.
Now, first thing is what is quantitative trading and why it is required. Quantitative trading, we must be all knowing that it is nothing but there are various stages in the quantitative trading. It is not only just passing the order, buy and sell order to exchange. So the various stages will start from the ideation of the trading strategy, and it will end in the going live with the trading strategy. So we'll go all the stages one by one. First stage is formulation of an idea. This we do. There are various activities we do into this. One is gathering and analyzing the data, and next is development of the hypothesis. Next stage is verification of the idea. In this stage, we verify the hypothesis which we developed using the sample database. We don't go into the detail of all the data set, but we just use some sample data set, and also we do the identification of the logical pattern in change of the prices, so that we can identify when to buy and when to sell. Once we do the high level of verification of the idea using verification of the hypothesis, we do the back testing. Back testing is nothing but the listing down all the detailed logic into the program and see how we can do buy and sell operations using that. And this has to be performed on the reasonable big size of that data set, so that we can check all the market scenario over the strategy which we have defined. Once we are fine with the back testing, we go over to the optimization of the parameter which we have defined in the back testing stage. Here we do the optimization of the parameters one by one, and once we are fine with the optimization of the parameters and our backtesting is performing well, then we can move it to the paper trading stage. Paper trading stage is nothing but performing the same operation which we have done in the backtesting in the live trading, but without investment. And once we are fine with doing the paper trading, means we have verified the logic which we have developed in the backtesting stage. We do the same thing in the live environment, but without investment. Then we go for the live trading. Live trading is nothing but whatever we have done in the paper trading, but with some amount of investment. Do you have any questions, Salil?
No. So as I understand, this is the standard flow of how one develops a quant strategy or some sort of trading signals. So we need to come up with an idea, verify it, backtest it, and probably optimize the parameters that go into the strategy making activity. Paper trading is, as I basically understand, it's sort of a driver of the strategy using fake currency, the paper money, and not the real money. And the final stage would be the live execution of your strategy, right?
Yeah, absolutely right. Here, the backtesting stage is most important because we need to understand, we need to test all the market scenario which we cannot test in the live market in the backtesting stage itself, so that we can see the impact of the market scenario over the strategy which we have developed, and we can mitigate the risk there itself instead of doing losing the money in the live trading.
Got it. Got it. Yeah. And when you say when you verification of your idea stage, when you're saying you are verifying your hypothesis, that is something which is different from the backtesting. What can you elaborate on the difference between the two stages,
Yeah,
verification of the idea? Yeah.
so hypothesis is nothing but there is the assumption without having the proper evidence and the logic. So let us say, for example, I want to develop some strategy based on the general election. That after each general election in India, the market goes up. Let us say this is one hypothesis. So to identify that, to verify the hypothesis, I'll take some sample data set, let us say for 2 or 3 general election, and see whether the market is going up or not after that. So, but
Got it.
and when we go to the backtesting stage, we'll do the detailed backtesting. We will write each and every rule there, and after that we'll take the big data set, which will take care of all the market scenarios.
Got it. Got it. Thanks for that explanation, Sunil. So one of our users is asking us that suppose somebody is coming with a background of a lot of technical analysis. He's good in reading the market charts and has been trading manually for a lot of years. How relevant is this field of quant trading for him? What all can he bring to the table, and what can he get from this exercise?
Yeah. The quantitative trading or trading using algorithm is very relevant for these kind of traders, because generally through chart we can just view some of the things. We cannot verify each and every rules whatever we are making. But using quantitative trading, we will be able to verify the longer period duration. We can do the backtest, we can do the paper trading, we can do the optimization, which is not possible through manual trading at all.
Got it. Got it.
And another thing is the quantitative trading or trading using algorithms takes care of the sentiments part also, which is a major problem with the manual trader. So sentiments will not be able to take over the logic part for the trader. So that is the main issue with the manual traders.
Got it. Got it. All right. Thanks, Sunil. We can probably move forward. Yeah.
So the next part is next thing is that how to develop algorithm for the trading. So this is, so far we have developed what was what was quantitative trading. Now we are checking how to develop the algorithms for the same. So there are 3 ways of doing this. First thing is, there are various algo trading platforms are available in the market, which we can divide that into 2 parts. One is no code, means we don't need to write any code for them. Another is there's 2 algo trading platforms which supports programming languages. I can give one example for both of them. For no code algorithm means you don't need to know the code, you just need to know the rules. It is very good. This is very suitable for the people who are manual traders and they are not familiar with the coding or programming. So they can just write their own rules and they can make rules here without knowing the programming at all. So these kind of platforms give all the infrastructure to fetch the data, you analyze the data, make the rules, and after that do the backtesting, and after that you can link the orders with the given exchange also. That is generally most of the algo trading platforms provide this kind of framework. And one of the platform I can say for no code is Tradetron, which is very famous in India. And another kind of one is which provides support to the some kind of programming language like C, C++ or Python. So there used to be one very popular platform called Quantopian, which is not which is closed as of now. And
Understood.
there is one more.
Yes, yes.
Yeah. So we can as of now in India, one of the platform I know is Quantitative Blueshift, which supports Python for doing the programming and developing the algorithms. So this is
Got
one
it,
way of
got
doing
it.
the algo trading, developing the algos for trading. There is one.
So, Sunil, I just have one doubt over these platforms. So, when you say there is a no-code trading platform and there is another which supports the programming languages, do they both observe the same sort of success? So, suppose there are probably two persons. One has no background of a programming language like Python or C++. So, he would naturally go to the no-code environment, Tradetron or whatever. So is he losing out on some sort of a very advanced techniques or some sort of a outcome or profit making activity?
Yeah, there is some difference between two of them. In no code, actually, you have to use all the features which is provided by the user by algo trading platform provided itself. You will not be able to use any other feature by your own. But
Got it.
in the other kind of platform which supports a programming language, you will be able to do anything whatever is Python supports. So you can develop your own techniques, you can develop your own features, and you can use them. So anyway, the platform which supports programming language has an edge over the no code platforms in that way, because those are much more flexible, and those are more recommended for the people who are who has technical background, technical IT background.
Understood. Understood. So probably the second platform, the programming languages gives the user a bit more room space or to customize it to a greater extent than the no code environment, right?
Absolutely, absolutely.
Understood. Understood. Yeah. Thanks.
These are so another advantage of these kind of platforms are you don't need to host your algorithm anywhere, because these all of them are based on the cloud. So you don't need to worry then whether the internet will go down. All the infrastructure part they will take care of it. So there is an advantage over here.
Yeah. Yeah. Yeah.
The second kind of second way of developing the algorithm is using licensed trading tools. These kind of uh, trading tools are actually client server applications which you can install in your own machine. And after that, these are almost similarly sophisticated the way the algo trading frameworks are, and they provide all the features to connect with the broker, connect with the data provider, do the back testing, and all other features to do the technical analysis. But you have to build your own infrastructure connecting. I mean, those are not based in the cloud. These has to be hosted in your own machine. So some of the examples are AMI Broker, MetaTrader, and NinjaTrader. These are very popular in India as well as abroad among the traders. So this is second set of way you can develop the software algo for trading. So these has all of them has their own language to do the development of algorithm in their tools. Third type is we can use the programming language or tools to develop our own uh, algorithm from the scratch. Like Python is very popular among them. Python is an open source language which generally people use uh, for developing algorithm for trading. There are some famous libraries are there in backtesting and technical analysis in Python, like BT, Backtrader, and TLib. TLB is very famous in technical analysis among all the libraries. And Python is very popular for machine learning and deep learning applications also. So we can use Python for predicting the price of the capital market and use that in the trading. So some of the popular libraries are scikit-learn and PyTorch for machine learning. And another one of the popular language for trading is C++, which people use very extensively. And last but not the least, we need to use visualization tools to to do the analysis, data analysis before the ideation of the trading strategy, and also after we need to analyze the trades and backtesting results. So visualization tools are very important in quantitative trading. So I will recommend Tableau and Power BI are couple of the very famous visualization tools in the market which can be used for this purpose.
So just for the knowledge of our audience, we'll be covering these libraries in more detail in the upcoming webinars and sessions. So don't worry about how you can use these sort of libraries and what are the other resources that goes into it. Sunil, I am seeing questions around this no code and supporting program language platforms for trading. So if you could just repeat some of the no code environments and the programming language environments that are available in India, for the users to try out. Tradetron is one I remember.
Tradetron is one for no code. Sensible is one of them in no code, and
so Sensible, Quantman, Tradetron.
Stock Mob.
These are some. Okay, so these are the no code environment platforms. Absolutely. Is it?
Yeah.
Got it. And for the programming language experts or people who want to customize their own language strategies, what all they can use?
So they can use, like, there is a tool called Quantitative Blue Shift is there, as far as I know. There used to be one Quantopian, that is not longer available now. But Quantitative Blue Shift, I know. There may be many more, but I'm not familiar with them.
Okay. Thank you, Sunil. Thanks. Yeah, we can move forward.
So there are various types of strategies which we can develop using quantitative techniques. One of them is arbitrage. Arbitrage is nothing but using the price discrepancy. It is using the price discrepancy as an opportunity to trade in some instrument. For example, let us say there's one instrument which is listed in two different exchanges. So at one place it is cheap, another place it is expensive. So we can buy the cheaper one and sell the expensive one at the same point of time. That is called arbitrage. And another kind of strategy is called momentum. Momentum is also, people call it price action kind of strategies. Whenever there is a change in the price and the market is going in one specific direction, we can use this kind of strategy. So there are some of the very famous methods to capture this kind of strategies. Simple moving average crossover. People use it very widely and extensively. Another kind of strategy is pair trading. Pair trading, generally people use it for if there are two instruments who has correlation between two of them. For example, Nifty and Bank Nifty are correlated with each other, and we know that if Nifty goes up, then Bank Nifty will also go up, and Nifty going down, then goes down, then Bank Nifty will go down. Let us say if it is not happening in some particular instance, then we can take the advantage of that, because at some point of time they will integrate with each other. So the co-integration will happen. So there are various techniques to do that. We can go into the detail later. But this called pair trading, where we are using two different instruments and finding the correlation, and based on that we are doing the trading. There is one very famous kind of strategy which is called event driven, which is based on some event. It could be any event, like for example, yearly budget from the yearly government budget. That is one event. Quarterly result of the various stocks. That is one event. General election is an event. Recession can be one event. And just some time back, we have faced a big event called pandemic. So that is one of the event. So people use them as a strategy to that, because these all of them has some repeated patterns, which can be used to make some strategy, and based on that they can do buy and sell. For example, we have seen that after every general election, uh, the market goes up. It doesn't matter who win or lose. This generally people has observed, and people make strategy based on that. And before every quarterly result, the volatility of that particular stocks goes too high, and after that it goes down. So these are various observation. The same thing happens in the budget. So we can develop strategy based on volatility. We can develop strategy based on price action, and another example could be like pandemic. In pandemic, the market fell down too bad, and after that it went up eventually. So you can take this as an example of mean reversion strategy. Mean it fell down too bad. After that, it has to go up. So you can buy at that time because it fell down too much. Then you can sell it later. Something like that.
Sunil, can you just elaborate on the mean reversion strategy for our users?
The mean reversion
strategy. So there is one type. The another type is mentioned here. So, all right. Yeah.
Event driven can be linked with any kind of strategy which we already have, but it is triggered by some particular event. That is the only difference. So like we were talking about pandemic, mean reversion is when some particular instrument goes too down or too up, then it has to come down to its mean, come back to its mean. If it is too down, then it will come back up. If it is too up, then it will come down. So that is mean reversion.
Understood.
I will go to the next slide now. There are various methods of developing strategies. We'll discuss it one by one. One way is, like we discussed, that quantitative research, and quantitative methods using statistics and mathematics. So in this particular way, we can develop the strategies. We can develop your own methods, own statistical, like using the statistical tools like standard deviation, mean, mode, and there is so many other like normal distribution. We can use all these tools, which are very popular in quantitative research, to develop the strategy, like correlation, co-integration. Another way is the conventional way of doing the developing the strategies, like technical analysis. We can use many technical indicators like SMA, simple moving average crossover, exponential moving averages, and we can use RSI. These are various indicators available in the domain, which we can use to do the technical analysis and come up with some strategy. Now, in the modern way, this was the conventional way of doing this so far, what we have discussed so far. Now, in the modern era with the new technologies, there is a very sophisticated and more accurate way of doing the analysis and coming up with some trading strategy. So, like in machine learning, we are able to classify the data. We are able to do the prediction based on the machine learning, based on the data. So we don't need to write too much logic or too much code into it, and we can come up with some prediction, and we can generate some ideas, to make the trading strategy. Another similar way is it is also the part of artificial intelligence. This is sentiment analysis, news or sentiment analysis, and generally for what happens. For example, if any news comes in for specific to some particular stock, or some Twitter, somebody tweets related to that, so you can write a program that it on runtime it will read the news and read the Twitter, and based on that it checks the sentiment of that news or tweets is done by some particular person. So it reads the news and tweet, and after that checks the sentiment, and whether it's positive sentiment or negative sentiment for the stock which you are planning to buy or sell, you want to trade. So if the sentiment is good, then you can plan to buy. If sentiment is bad, negative, then you can plan to sell. So this how the sentiment analysis is being used. So it takes care of the NLP part. I mean, you need to understand the language and the content within that, and you need to derive the quantitative numbers, that how much it is positive for the stock and how much it is negative to the, you have to convert that into numbers. So that's why it also somehow it falls under quantitative research also. Salil, you want to ask something here?
No, not really. I was just thinking about the machine learning type of the developing strategy. How, what would be the typical time frame in which, if one, let's say, starts developing some sort of a AI behind your strategy? And I'm assuming you need to have a very strong background in ML or AI. Only then can you practice this sort of research.
Yeah, I can give you some example that what kind of strategy which I have developed in the machine learning, that give you some idea that what else we can do about it. So what I'm going to tell, it is not the only methods, but there could be so many others. I will just tell that what I have developed so far. For example, I predict the price of the stock at 3:15 before the market closing. That what will be the price of the stock at 3:09 next day 9:15. So I just check the what are the stocks of Nifty 50 will have gap up opening or gap down opening. So I predict the price of next day opening. So this is what I predict. This is one way of doing that. Another way is I check at 9:15 itself. I check what are the stocks who will end up in closing red or end up closing in green.
Okay, so basically, how many will give you a positive return and how many will give you a negative return? And we're talking about an intraday strategy here, right?
Strategy. Yeah.
Okay.
And there is one way is I check that for Nifty 50 and Bank Nifty, that what will be the high low close of the day for that particular day. I predict that at that time of 9:15 itself.
Okay, understood. So what I'm learning from this machine learning sort of a strategy is it has a good predictive power using a computer analytics or the data analysis, and in some way predicting what will happen in the near term or long term.
Yeah, absolutely. Even this I'm telling you, only in the shorter duration. But if you try to predict in the longer duration, anyway, it will be more accurate.
Oh wow.
Yeah, because predicting anything in the smaller duration will be more difficult. But predicting the same thing in the longer duration, the frequency is more, then it is more easy to do that. One of the strategy which I have developed now, as of now, is it predicts the direction of the market in the longer time frame. I mean, even it checks only 10 minutes data, but it checks for that how long the direction, how long the trend will be, whether it will go for 1 day, whether it will go for half day or 5 minutes or 10 minutes or 1 hour, something like that it takes.
Understood. So Sunil, when you say that technical analysis and quantitative research methods of building some sort of signals and strategies was the conventional way, and this machine learning or NLP or sentiment analysis the new way. Do you see a lot of new algo traders moving towards these sort of strategies?
Yeah,
Do they have a real competitive edge over the conventional way of trading?
absolutely. As I can tell you, like I didn't had background of the trading at all, no trading and finance background. I was totally from IT and I had around 18 years of experience in that. But eventually, so I use that experience and that knowledge as a skill to develop trading strategy in this domain. So I didn't know much about trading techniques, so I just used machine learning to do the prediction, and based on the prediction, I was developing the trading techniques.
Got it. Got it. Yeah. Thanks, Sunil.
Shall I go further?
Yeah. We can.
So some of the interfaces which are required uh, for quantitative trading, it actually we need to connect with the broker's API to place the buy and sell orders, and we may require the broker's API to fetch the historical and live data also. So some of the broker provide both of them, and some of the broker provide only one, like placing the buy and sell orders. So in case you want to fetch some additional data, which is not provided by the broker, you can connect with some data vendor also. And for that, you need to have data vendor API. So again, you can connect with the data vendor API to fetch the historical and live data. The historical, when we talk about historical and live data, it may not be limited to the price data. Generally, price data we talk about open, high, low, close, volume of the instrument, but it can go much beyond that. It may be macroeconomics and microeconomics data also. For example, you can get the budget data, the GDP data, and the employment data. All those data also can be used in your strategy. It all depends what exactly you want to develop.
So, Sunil, I might be not the expert on this parlance, but when you say we have this API interface involved with running strategies, what do we basically mean? Is API some sort of infrastructure or ecosystem where we place a strategy? Is it different from, yeah?
Yeah. API is actually named as application program interface. It is you can say it's the interface to link two different applications. So like you have one application which has your algorithms. Now your algorithms are based on some kind of data. Without that, you will not be able to develop your trading techniques.
Right,
So you
right.
must be using historical data to develop the techniques. So the historical data has to be provided by someone. So that will be another application. That application lies with the broker or maybe data vendor provider. So you will take it from him. So you can say it is just a interface between two applications. And in our case, it will be data will be interface between two applications.
Got it. Got it. So it's basically the bridge between our strategy and the exchange
Yeah,
where the
absolutely.
orders will place.
And
Understood. Understood.
eventually, once everything is done, then you have written the logic and the calculation of the logic has happened. Then buy and sell orders has to be placed. For that, you need the broker's API. And through that, you can send the buy and sell orders to the broker. And it will eventually broker send it to the exchange.
Understood. Understood.
Okay, I will move it further. Now, the one of your initial question which you have asked, that what are the skills required to develop quant model? So like a manual trader can become the quant trader or not, or whether he can adopt these kind of techniques or not. So we'll come to that now. So first and foremost, skill which is required is statistics and data science. So in this, actually, even whether you know programming or don't know programming, statistics is very good tool to develop trading techniques with or without the technical analysis. So you can merge both of them. Maybe you can use data science and trading technical indicators, and maybe you can use just this one. People use generally both of them together to develop the trading techniques. So next, very important thing is problem and puzzle solving skills, or you can say analytical skills also. If you have this skill, then you can like statistics and data science is nothing but the tool, and this is actually the skill by which you can use this tool to develop the trading techniques. And if you know these two skills, then after that, and if you know the programming also, then 90% of the job is done, because now you have to develop the your algorithm. But even if you don't know the programming, that as we discussed in the previous slide, there are few algo trading platforms where no code is required. No code, they work on the no code. So you will be able to develop your rules and you can implement the rules without any coding. But if you know the programming, then you will be able to develop more sophisticated and more detailed algorithm by yourself. And last but not the least, the basics of capital markets is very much required. Without that, you can do many mistakes. So this is very much required.
Yeah, I think this one is important, right? Because we receive a lot of queries regarding who all can get into this field of algo and quant trading and all. So yeah, so when you say statistics and data science, well, what sort of an level is it? An intermediate level? Is it an advanced level? And for the same aspect, how advanced does your programming need to be if you really want to make it far in this field?
I would say at least intermediate level is required, not the beginner level. If it is advanced, then there is nothing like it, but at least intermediate level is required. Now, if we talk about what is data science, then data science is the way to extract important information of the raw data using various data analysis techniques like data analysis, data gathering, data mining, and predictive analysis. Using this is what is called data science. So we need to extract important information to when to buy, when to sell from the raw data or the price data which we have.
Understood. Understood. So Sunil, sorry to ask you to move to up this previous slide. We are receiving some questions on the previous slide. Yeah. So some of our users want to know: do we have can we have some examples on the data vendors where we can get our data from? And does it all require some sort of a cost associated with this?
Yeah, there are few data vendors are there, and there are few Python libraries are also available in the market, which you can use it without cost. Like I would say, Finance is one of them, which is free of cost, and you can fetch data live as well as historical data without any cost at all. So Finance is Finance is based on Yahoo Finance. So this is not
Okay.
the official API I would recommend, but this is open source and many people use it. So
Okay, so
another,
Yahoo Finance or Google Finance, these are some open source.
the Finance is the name of the library, which is very popular among the traders for doing
Okay.
backtesting. Who does the backtesting by themselves in their own paid machines? And if you talk about paid one, then there is something called uh, Bloomberg is there, and Zerodha also provides some kind of data. And I understand ICICI also provides data. So I don't know about the cost associated with that. Maybe you can put some more light on that.
Yeah, yeah. So yeah, there are a lot of trading APIs out there, ICICI being one of them. So we also provide data, but yeah, for some of the open source platforms which you're talking about, like Y Finance or Bloomberg, yeah, you can get the data from there as well.
Yes, there is something called True Data is also there, which is also paid way of and there's many more are there. If you find out in the Google, we can find out so many. But this is one of the prominent name which I can remember as of now.
Understood. Thanks, Anil. Thanks.
Shall I move further?
Yes, we can move on.
So now we can discuss about what are the educational resources for developing the strategy. One way is one way is to going through with the blogs. If you're already familiar with trading strategy, if you already know everything, then just reading the blogs will be maybe enough. And some of the popular name in blogging site I can know which can be helpful in giving some idea to you for developing strategies are Quantocracy. It is very popular. And another name I know is Quantensity blogs. That is also very popular among the traders. If you talk about online courses, then Quantensity has some of the courses related to the quantitative trading, and Coursera, Udemy also has some of the online courses which you can go through with that. If you talk about books, there are so many books are there. So I will not be able to recommend any one of them here. But many books are available which you can go through with that. If you talk about my personal experience, I don't refer to any blog or I don't refer to any strategy. I just focus on the statistical tool and mathematical theorems, and I use them to develop my own strategy. So this way, sometimes it happens that I come up with something very niche and unique, which has never been done before. So I recommend this also. This is also one of the way to come up with the strategy instead of going through with some blog or online process.
Okay, so let's say somebody, let's take an example of a typical employee of an IT firm. So he doesn't have time to go through books or subscribe to expensive online courses. What he can probably do is play around the codes and just set up the infrastructure and come up with new techniques as you did yourself. That's possible.
That is very much possible. I can give you one very simple example. This example, the traders who do the trading, they will be able to relate it very much. For example, we do the simple moving average crossover. So in the simple moving average crossover, we do the short simple moving average is greater than long simple moving average. If it is greater than if short moving average is greater than long moving average, then we go for long. Otherwise, we go for short. Instead of that, if we just take the ratio of both of them and see whether instead of comparing it with one, if we compare it with some decimal, we can get some much better results. So this is the way I developed my own strategy. So similarly, the people who are familiar with mathematics, they're fine with mathematics and statistics and programming. They can develop their own techniques instead of going through or referring to some existing strategies.
Got it.
Do you have any more questions, Harry?
Okay. I think we have covered the important hygiene questions that have been posted. Just let me see if we have missed some of the questions. So yeah, so some of them are asking about the backtesting platforms that are there. So let's say we have crossed the development and designing of the strategy, and now we need to stress test it for different scenarios and essentially backtest it. So are there different platforms? Do we need to shift from our, let's say, coding platform to a different platform for backtesting, or how do we go about that?
Like we have discussed, there are two ways of doing the backtesting. One way is that we have the backtesting platform. We can use the online backtesting platforms. Like we discussed Tradetron, Blue Shift, and Strike, and there's so many others which are available in the market. We can use them, or we can, if it is possible that they may not provide all the features which you are looking for, and they may not have all kind of data which you are looking for to do the back testing. So in that particular case, you can develop your own strategies on back testing uh, algorithms in your own machine and use your own data to do the back testing. So it all depends upon your strategy and type of scenarios which you want to test. And stress test, if you talk about stress testing, then you need to see that how many trades it can take. So it all depends the kind of strategy which you have. Stress testing may not be required as of now because it will be required mostly on the HFT kind of strategies. So which we are not discussing as of now in this session.
Okay, since we have touched upon this new word HFT, so can you shed some light on how different is a high frequency trade algorithm, and what sort of infrastructure they work in versus what a retail participant like us developers can do?
High frequency trading is generally done by the institutions, big institutions, because in high frequency trading, first we'll just understand the meaning of that. In that, the frequency of the trades are too high. It means it almost goes to the millisecond basis. Mean every millisecond, either the trades are being passed or the calculation of the logics are being happened. If the
Right.
trades are not being passed, so the many times it happens within milliseconds. You buy and sell both the time and make the profit out of it. So, and for that you need to have co-location in the exchange itself. Co-location means generally, like we have discussed, that we are taking the data from the exchange or the vendor, and we are passing the buy and sell orders using the broker's API. In that case, in HFT, we need to have so that the time is very important. You need to do everything in the milliseconds. So you generally the big institutions buy the space in the exchange servers itself and place the order, buy and sell order, and take the data also immediately from there, so that they can do everything in milliseconds.
And I
So
guess buying up space in the exchange servers is pretty expensive too.
absolutely, it's very expensive. So it is not easy for the retail users like us. That's why I repeatedly said that those are done by institutions. So it's better we don't think of doing the HFT by our own unless we have too much money or we are institutions.
Got it. Got it. And the extension point to the cost that is associated with this idea of developing your own signals and quantitative techniques. So, do we need to have very expensive resources like some sort of a supercomputer or some sort of a very fast internet, cable, optical fibers on the architecture aspect of it? How expensive do you think this all game is?
I would say those are not too expensive, and we just need to have stable infrastructure. Like I do most of the things from my computer only, and I'm planning to go to the cloud very soon. But as of now, I'm able to do all the algorithms. I'm able to run and calculate, do the calculation all the for all the algorithms in my computer. That is simple laptop which has 16 GB RAM and maybe 500 GB hard disk. That's all.
Got it. Got it. Sunil, we are receiving some more questions from our users. So people are asking if there are some instruments that you can highlight. Like they just want to know, can we trade on instruments like Nifty, Bank Nifty, so
Uh,
and so forth?
I didn't get to create the instrument.
So what would be the available instruments? Let's say we have designed our techniques and strategies.
Mhm.
What all instruments are available for us to deploy our strategies on? Can we, let's say, buy Microsoft, or can we do something with the Indian exchanges only?
Uh, Yeah, there's, if we talk about instruments, then there are some, these are the underlying instrument like Nifty, Bank Nifty, even the stocks. So if we can make use of the other instrument related to that. Let us say you have Microsoft, you can buy that in the cash market, as well as you can buy the futures, you can buy the options like call or put, something like that. So, and you can even go for EFT for that. So for each kind of instrument, there are multiple different instrument types are there where you can do the trading accordingly. Did it answer the question?
Yes, yes, Sunil, it very much did. Um, yeah, I think we have covered most of the questions. To all the users, if you have some questions, you can post them in our chat. We'll be more than happy to take them. So, Sunil, some of them are asking about the sentiment analysis. And if you could elaborate our understanding on how that essentially works. Do we scour the internet or the Twitter space and the Facebook space? How does that work?
So if you talk about sentiment analysis, I think the most effective way of doing the sentiment analysis is using the Twitter analysis. Because if we see most of the people nowadays, all the big celebrities, even the president of the country, the prime minister of the various countries, don't do for news conference. They just tweet by themselves. They have their own Twitter handle. So it means whatever they say or whatever they want, they can communicate directly with the audience. So in
Right,
that sense, what happens? The information which they want to pass on to us comes much more before the news article. So instead of reading the news article, we can just read the Twitter handles of some of the influential people, and we can read them and we can analyze them on the online. So Twitter also provides some kind of API which you can make use of it. So we can take the data from that API, and after that we can read. There are some sentiment analysis libraries are there, NLPs like Spacey, NLP. These are some of the machine learning sentiment analysis libraries. Using that, you can understand what is the meaning of their tweet which they're passing. So you can on runtime, you can understand, you can convert that into positive or negative sentiment and relate it with the instrument which you want to buy. And after relating, if it is positive sentiment, you can go for buy. If it is negative, you can go for sell, like that. But again, you need to do the back testing. Without that, I don't recommend anything, any kind of logic to be placed without that.
understood. Very rightly said. Okay, so one of our users is asking, so are there like some typical time intervals for which you design your technical indicators? For instance, there is SMA. So do you have very fixed intervals, or do you try to tweak and experiment around the 14-day, 39-day, or whatever period that is there?
I would say that whatever generally we should not go with some fixed interval for each any of the instrument. We need to see how relevant they are. There is something called autocorrelation. So in correlation, we get to know if the same instrument is how much it is correlated with the previous interval of that same instrument. For example, if you want to predict what is going to happen in next candle of the instrument, let us say Nifty 50, what is going to happen in next one day. So we need to see that particular day is related to how much back period, uh, rolling back period of that Nifty 50. So we need to see, it may be one day, we need to check whether it is one day only relevant, 2 day relevant, 5 day relevant, 7 day relevant. If we are taking just like that 14 days for each of the instrument, it may not work every time.
Got it. Thanks, Anil, for answering our questions. I'll just go over the chat once again to see if we have left any question. Yeah, I think we have covered most of the questions. I would like to thank you for your time, precious time, Sunil. I believe this was a wonderful session that was taken by you. And just for our audience, we have more webinars planned for you guys, which will give you a very practical overview of how Sunil or a typical quant developer takes the designing of the strategy and the backtesting aspect of it, and the pitfalls that are associated. Where can you go wrong? What are the some of the standard resources that you can use? More on this in the upcoming webinars. So please watch this space for more. Sunil, if you would like to give some sort of a closing remarks, more than welcome.
First of all, thanks to you, Salim, that for moderating the questions between me and the audience. And you played a very wonderful role. And as you said, that in the coming sessions, we'll cover so many other things which will be very exciting to the users. And those will not be just theoretical, that will be the practical approaches, which can the audience can use very fruitfully. They will be able to use them into developing the algorithm that will be very useful for them. So we are looking
Absolutely.
forward for the next few more sessions. I'm feeling very excited about it.
Yeah, me as well. All right, guys. Thank you for your time. See you next week.